MPW reported their earnings yesterday before market open, and over the last month they are up over 17%, and even when we take a look at their valuation grade, they get an A+. So is this an undervalued buy now after reporting their earnings? We're also in today's episode going to consider their dividend safety, which has been downgraded to a score now of 10, very unsafe, and we will also look at their latest investing earnings, running through the numbers, talking about some of the positives that we see, as well as how they performed against analyst targets. And as always, we will look to both their top line revenue growth, their bottom line net income, and the health of their overall balance sheet to ensure that those dividends will continue to be paid, cash versus total debt. We'll also incorporate any insider buys and sells, as well as look towards the institutions. And in today's episode, we will go through a revised valuation model, getting to the intrinsic value, our acceptable buy price given our investor margin of safety, and see whether or not Wall Street do now see some very large upside over the next 12 months. So the first thing that we will start off with is a very high level of how their earnings went against the analyst targets. And what we can see here is their FFO, so their funds from operation, were around 24 cents per share, and we can see analysts were targeting around 25 cents. So there was a marginal miss on the FFO, and when we do look at the FFO from a year ago, the same quarter, it is significantly down. 0.24 in the current quarter in 24, same quarter last year 0.37. Now when we take a look at their revenue, so their top line, they did post 271 million for the quarter ending March 2024. What we do note, it was down. They did miss by analyst targets by 4.23%, but we also know unfortunately their revenue is also down from the same quarter a year ago. So earnings, it wasn't that great, just at a high level. They missed on the FFO, they missed on the revenue, as well as lower than the same quarter last year. But there is some good news that we will take a look at through their press release. Now, when we take a look at just the overall historical performance, first thing to note, they are sort of towards the mid to lower end of the 52-week range. In terms of analysts, we do get 2 hold ratings, 1 sell by quant, and in terms of a forward yield, it does sit at 12.79%. Now, over the last month, as we mentioned, very strong performance, up 17.54 from the lows of $2.92 per share. Year to date, we note, however, they are down around 4.48%. Over the last 12 months, down 44%. And if you've been a shareholder, unfortunately, over the last 10 years, you would be down horrifically negative 66%. If you were to have reinvested your dividends, you would be up slightly higher. And we do see all-time highs sitting around the $24, $25 mark in 2020. We do also note at the back end, or in fact the beginning of 2022, it did also hit that region as well. So let's take a look at our analysis. Is this undervalued? Is this one now, with the growth that we have seen as well as their earnings, one we can get behind as an investment? In terms of their top line revenues, now for typical companies on the channel, 3 to 7%, for REITs 5 to 10. We note their top line December 2014, 315 million reported. Latest annual accounts, 886 million. So what we can see is it has grown, in fact, nearly 3 times over the last 10 years. But when we look on a more graphical basis, we actually know there was some positive growth up to 2021, looked very good. It then stalled in 2022 before a decrease. Now, some part of that is due to Stewart Health, which we can discuss later on, and there is a little bit of good news around that. And what we look here now, on a trailing 12-month basis, we do see around 807 million. So hopefully for the full year of 2024, we will see some growth from that 2023 number of 886. In terms of the bottom line net income, well, how does that compare? Well, 50 million reported in 2014, up to 2022, looking very good, 903 million. Their full account for 2023, now they made a loss, 556.5 million. Again, they did have to write off a lot of their revenue, as we can see. But again, if you do believe that is a one-off case, up until that point, for the large part, it was looking very healthy. December 2023, as we clearly see, being a net loss. Very important, this company does pay a very high dividend, so how is the safety and the health of the balance sheet? Total cash, well, 144 million in 2014. Latest quarterly report, it has nearly doubled, 224 million, and we do see a lot of inconsistency year on year with their cash position. It did peak in 2019, but since then it has started to come down. Now, how does that compare numerically and directionally to their total debt? Well, we've seen it has increased from around 2.2 billion in 2014 to just over 10 billion. So it has in fact nearly increased 5 times over the period. And unlike the essential cash, which was very inconsistent, we do know their total debt over the longer term has been increasing, something that we will factor in when we do visit their dividend safety, as that is very important when you do have a yield touching 13%. So in terms of their earnings, the FFO, how have they performed historically? So over the last 4 earnings, actually quite positive. They did have a 75% positive record. In fact, quarter 2, 3, and 4 of 2023, they did beat, as we can see, year on year, quarter on quarter. What we do notice, though, as we mentioned, they did miss in Q1 by 1 cent, unfortunately. And the expectation over the next 4 quarters is that for the next 3 of them, year on year, it is expected to be a double-digit decrease, as we did see, in fact, even this quarter from the previous year, it is also down. However, quarter 1 of 2025, they are expecting growth of around 16%. So it looks like it will take a while before things do turn positive, but the expectation is there Q1 of 2025 for that to take place. Now, when we take a look at some of their valuation metrics, the first one that we're looking at is the valuation and underlying metrics of an A+. Now, there are lots of different ways you can value companies. The one that we do believe to be the most appropriate for companies that are REITs, real estate investment trusts, is to look at the P, the price to AFFO, adjusted funds from operation. On a trailing 12-month basis, TTM 3.94, with the sector median coming in at 13.91, so they are nearly 72% cheaper, I guess you could say, than those in this industry. When you were to look on a P to FO forward-looking basis, 5.13, as we can see here, the sector median a lot higher, 14.6, so they do trade at a 65% discount to others in the industry. Now, there are other methods that you can look at. Again, if you want to use it as part of your investment thesis, you can see them. But the main ones that we do look at, the P to FFO, looking very positive. But that is just purely looking at this in isolation. We then take a look at their growth grade. Now, they do get an F. No surprises there, given we just did review their income statement, especially over the last year. Now, historically, their AFFO has, in fact, decreased -8%. We see the sector median positive 4%. Over the last 5 years, again, very similar story, negative versus a positive sector median. And when we look on a forward basis, it is expected to decrease -12%, hence the D- grade here. When we see the sector median, although very marginal, at least an increase of 1.71. Few things just to think about as well, and we can always factor these into our margin of safety when we do take a look at the valuation later on. In terms of the profitability, well, they get a C+. Now, some of these metrics we will take a look at in further detail, like the payout ratio. But again, you can see here some that do look fairly positive. If you're interested in the cash from operations, for example, 506 million, when you do have the sector average around 231, so significantly better there. Now, what I would say is when we do take a look at their performance against others in the industry, there should be no surprise about the results. We have other healthcare REITs, National Health Investors, Sabre Healthcare, Care Trust, and some other popular ones. Over the last year, now total return, including dividends reinvested, MPW is the worst performing, down -37%. Over the last 5 years, again down -61%, and over the last 10 years, -29.51%. Not the greatest, but what I would say is here, just bear in mind that past performance is never an indicator of future performance. So again, don't expect that they will be that poor over the next 10 years. Doesn't mean they won't be, but as always, don't use this as a basis. Now, what we want to have a quick look at is insider movement, so 1.53% in terms of ownership. We have 3 instances of selling, however, this is over the last 3 years, and this was around 19.24 million. You would have to go back quite significantly far to essentially, as we can see here, quarter 2 of 2022 for 6 million worth of sales. Quarter 1 of 13 million. And when we take a look at who these insiders were, we can in fact note here that the CFO and the CEO both sold around the 7th of April, the 30th of March, so not in fact too far away from each other, and a significant number of shares when it was trading in the $21 region, right there towards the top, for a total value of just under $20 million. Now, because it is outdated, we can't really use this in our investment thesis, but interesting to note that they did sell not too far off the top. We also note the director did in fact sell as well within that period, 6,000 shares for around $120,000. Whether or not you want to factor this in, the information is there, the transparency is also there. When we move on to institutional ownership, 72%, we can see 542 million worth of sales by the institutions over the 12-month period, but we see a lot more buying, 886 over the exact same period. But the only thing that I would say, yes, more buying than selling by the institutions over the last 12 months, but over the last 2 quarters, Q1 of 24, Q4 of 23, we do see more selling. So overall, yes, there has been more buying. You do have to go back to Q2 to see the largest buy, but over the more recent period, we do know institutions have been selling more. As always, though, do your own due diligence and never copy what insiders do, never copy what institutions do, but the information is there. So let's take a look at their own press release that they did put onto essentially their company, so you can go and have a read as well. Few things to note. Now, firstly, debt, as we can see, net of cash has been reduced by approximately 1.6 billion since the first quarter of 2023. Now, that is positive. One of the reasons they were able to do this was, as we can see here, they sold in April a 75% interest in 5 Utah hospitals for around 1.1 billion of total proceeds. So that did help the balance sheet of this company. As we will find out, the net debt to EBITDA is significantly high, so that will help alleviate some of that stress of the high dividend. And we also note they are paying a regular quarterly dividend of 15 cents per share. A lot of people were worried and were waiting for this, but they did announce that this will take place. And when we take a look at the actual numbers, well, they had a net loss of $1.23 and normalized funds from operations of 24 cents for the first quarter. As we can see, the net loss did in fact include around 693 million in impairments. Main reason for this, as we stated earlier, in relation to the Stewart Health, where they did have to write off a fair amount. Now, there are other things that they do talk about, but as we can see, that main one there, selling quite a significant interest for quite a significant amount. Now, you can take a look at this if you want to go onto their own website and read more in detail. It does go into quite some length. One thing just to note for those that don't know, they do have around 17.4 billion of total assets. They have properties across the US, not just the US, in fact, the UK, Switzerland, Germany, Spain, Finland, Colombia, Italy, and Portugal. So it isn't a small company. They do have quite a wide coverage, just again for those that aren't too familiar with this company. Now, before we take a look at the dividend safety, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any other articles, all completely free, all instant access, click on the pinned comment below. And for those that always ask, what are the websites you use? Where do you get your resources? In this article, we do run through every single one. So if you want to take a look and review and analyze companies like we do, the information is in there. Now, dividend safety score, 10, very unsafe. You don't really want to see this in any company you invest in, let alone a company that they are giving you a very high yield. Market cap, 2.84 billion. It is a mid-cap company. And for those, I'm sure you know by now, they did cut that dividend last year by negative 48%. So as we can see here, they get a 10, very unsafe score, and what this essentially means is that it does suggest a high risk of a dividend cut over a full economical cycle, and we'll run through why this is based on and what metrics support this dividend potential cut again. So key metrics, they did cut the dividend during the last recession, the 07-09. In terms of sales, negative 5.2, although slightly above the average of the S&P, which was negative 12. They also had a negative 76% recession return. As we can see, the S&P, negative 55. Dividend growth, well, no surprises there, negative 48%, which unfortunately means on average over the last 5 years, the dividend has reduced by negative 3%. And if you've been a shareholder over the last 10 years, it would be up around 1% year on year. In terms of growth, well, again, no surprises, 0 years of consecutive increases, 0 years of paying without a reduction, given the August 23 dividend cut. In terms of looking at dividend yield theory, now this isn't one that we will use for MPW, but typically states a company is undervalued when the current yield sits above the 5-year average. But again, we would say, as we can see here, it does appear to be speculative, as it does look to be very, very high and unsupported. Forward P to AFFO 4.9, lower than the 5-year rolling of 14, and we also note it is lower than real estate's 14 as well. Just bear in mind that any one of these models, we don't look in pure isolation, and we will conclude towards the end of the episode. Now, adjusted funds from operation, always what we use over the free cash flow when we look at REITs, as it is a lot more volatile. Below 90% if we want to be specific for the industry. Here we have the medical building REIT. For the large part, it has been below that. 2023, very high at 94%. No surprise then there was a dividend cut. What is good news though for shareholders is that it is expected to reduce around 62% over the next 12 months. So that is a positive sign, a first good step in terms of looking at the dividend safety. AFFO, well, as always, similar to free cash flow, we want to invest in companies where it does increase over the longer term. Unfortunately, it has taken a hit in 2023. Otherwise, it was moving, although inconsistently, in the right direction. A little bit of growth expected into 2024. And for those that do like to look at the percentages, we can see here over the last 2 years, or in fact 2023 and expected 2024, we are expecting double-digit negative growth. And before then, a little bit inconsistent, some solid years, as well as some years, in fact, back-to-back of negative growth. And when we look at their top line, as we covered already, 2023, a massive drop to that top line, although prior to that, it was fairly healthy in the double-digit region. Then when we take a look at it numerically, this is something we've already covered, but you can see it in a different format. The shares outstanding, yes, we love it when companies do those share buybacks, essentially returning excess cash as you then have more ownership of the company. What we have here is the opposite, although very typical, where your position is diluted. Very common in the REIT industry. Just have a look at other REIT videos. You will notice they do dilute your position at a fairly rapid rate. The only thing we would say is over the last few years, it has been very minimal. That is a positive sign if they do continue with that moving forwards. Then we look at the ROIC, return on invested capital, 10% or more typically, however 3 to 5 for REIT, does give us faith that management are able to effectively allocate their capital. Again, up to 2022, it was looking pretty positive. 2023, that has really harmed them, down 1%. Definitely something to keep an eye on if you are an investor of this company or if you are a potential investor. The same thing does go for the operating margin. It was very solid up to 2022. 2023, 11%. In fact, trailing 12 month at 4%, this is definitely something to keep an eye on and again, really factor into your investment thesis as well as your margin of safety. So you might be thinking, look, we saw the essential payout ratio, the AFFO, it was very healthy. Why does it have a 10 dividend safety score looking very unsafe? Well, this metric, the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, correlates both dividend safety as well as balance sheet strength. These are the number of years it would take the company to pay off all of their debt net of cash on hand. Typically, we want to see between 3 to 5 when we're being industry specific for building REITs below 6, so we do give a bit more leeway. Pretty much every single year they have been above that, significantly in 2023. So if you were watching these episodes, you would have seen a dividend cut inbound. 2024, now yes, it is reducing or expected to from 2023. Good news that they did get that 1.1 billion from selling these hospitals. But it is still 10.16, so this is definitely something to consider moving forwards. Now, it doesn't mean that if they cut the dividend, the share price will in fact fall. It could be the opposite. If they do cut the dividend again, it could be one that it does increase, as people do like the way that management are moving towards helping the company in the longer term. But as always, do let us know your thoughts about that. Would you rather see a dividend cut, or would you rather keep paying that dividend if it does mean they will struggle year on year? Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now we can jump into the first valuation model for today's episode. Typically we have 4 models: Graham, multiples, DCF model, dividend discount model. Graham's valuation, it isn't relevant for essentially REITs, so therefore we don't include them. Multiples valuation, given the fact that this is trading at an incredibly low essential AFFO ratio, this isn't one that is appropriate, and when you do compare it to others, this would give a very skewed number. So the first one we're looking at today is the dividend discount model. We have the yearly dividends. Now we do note that dividend cut last year, so we can see the average growth rate negative 7%. We want to be conservative, so we have estimated a small dividend cut of negative 5%. If we were to use this, it would give an intrinsic value marginally lower than the current value, 438 versus 481. So we do have an overvaluation signal, although it is a very marginal one, as it is around a 10% drop. Then we move on to the DCF model. We have the free cash flow year on year. Moving forwards, again, we've been very conservative, reducing around negative 6%. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding. And we can see here an intrinsic value showing undervaluation. So we have one overvaluation and one undervaluation, which we will pull through to the intrinsic value calculator. Now, do bear in mind, you can grab a copy of this model to get to your own intrinsic value and acceptable buy price. Whether you want to run through MPW, whether you want to put your own companies through or on your watch list, you can do all that. Don't forget, click on that pinned comment below. Margin of safety then, as always, we do start off with 10% and we only execute if we believe it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. So if you believe that for MPW, it would be a buy around 449, but what we can see right now, it doesn't warrant that. At a 5% margin of safety, it isn't too far off, but in today's episode, you are sitting around a 0 to 5% MOS level based on our estimates and judgments for Medical Properties Trust. Now, in terms of Wall Street and their expectations over the next 12 months, they do see some growth. In fact, they are pretty much in line with our own intrinsic value near the $5 mark, but they see around 3% upside, as we can see here. As always though, do let us know your thoughts in the comments below. Is MPW one that you are looking to buy now after the earnings? Is it one that maybe it's on your watch list? Or maybe you're a shareholder and you're looking to sell? As always, let us know below, and if you enjoyed the episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.